HDFC Bank analysis. Is India's largest private bank still a great investment? When people think about banking stock in India, one name almost always comes up: HDFC Bank. For decades, it has been considered one of India's highest quality bank. Strong management, consistent growth, low bad loans. But after the merger with HDFC Limited, investors started asking an important question: can HDFC Bank continue delivering strong returns? Let's analyze the bank using real financial data. Company overview: HDFC Bank is India's largest private sector bank by market capitalization. This bank provides retail banking, corporate banking, loans, credit cards, wealth management, digital banking services. There are 9,499 branches, 21,000 ATMs present across 4,100 cities and towns, and more than 2 lakh employees. Its scale gives it a major competitive advantage. Revenue and profit growth. One reason investors love HDFC Bank is the consistent profitability. Net profit around 17,000 crores, growth is 6.7% year on year. Net interest income NII 32,000 crores, NII growth is 10% year on year. Profit after tax is 18,000 crores and growth is 12% year on year. Even after becoming much larger through the HDFC merger, the bank continues growing profits. Deposits and loan growth. Banks grow by attracting deposits and lending money efficiently. Deposits, total deposits 27 lakh crores, growth 16% year on year. Loans, gross advances is 26 lakh crores and growth is 6.7% year on year. Advances under management growth is 8% year on year. The bank is currently prioritizing deposit growth after the HDFC merger. This is important because healthy deposit growth supports future loan expansion. Asset quality. One of HDFC Bank's biggest strength is asset quality. Bad loans are measured using GNPA, gross non-performing asset. GNPA ratio is 1.24%. For comparison, Indian banking industry GNPA ratio was around 2.2% in FY25. This means HDFC Bank bad loan levels remain significantly lower than many peers. Low NPA helps protect profit during economic slowdowns. Capital strength. Strong banks need strong capital. Capital adequacy ratio is 19.9%. CET1 tier ratio 17.4%. The regulatory requirement is far lower. This gives HDFC Bank a large safety buffer and room for future growth. Challenges investors should watch. No company is perfect. Challenge 1: lower margin. Net interest margin NIM has declined compared to pre-merger levels. It is around 3.3% on asset. Investors want to see margin improve over time. Challenge 2: loan to deposit ratio. After merging with HDFC Limited, loans grew faster than deposits. Management is working to reduce the ratio towards 85 to 90% by FY27. Challenge 3: regulatory and governance headlines. The bank has faced scrutiny around certain internal matters and governance related reports. Investors should monitor developments carefully. Why many long-term investors still like HDFC Bank? HDFC Bank still has several advantages. Strong brand trust, massive customer base, consistent profitability, excellent asset quality, strong capital position, nationwide banking network. Many investors view it as a core long-term banking holding rather than a high-risk growth stock. Is HDFC Bank likely to become a 10x stock overnight? Probably not. Is it now a very big institution? But it can continue compounding wealth steadily over many years. That's the key investment thesis. HDFC Bank remains one of India's strongest private sector bank with healthy profits, low bad loans, strong deposit and solid capital strength. The biggest thing to watch going forward is whether the bank can improve margins and accelerate growth after fully integrating the HDFC merger. For long-term investors, HDFC Bank remains one of the most closely watched banking stock in India.